The global monetary system that has controlled your wealth for 80 years is facing its greatest challenge in decades. While mainstream media focuses on political theater, a precious metal crisis is unfolding that could reshape global wealth forever. Silver just hit $71.94 per ounce in December 2025, up 141% year to date. And this isn't just another commodity rally. It's the beginning of a supply shock that will make previous metal shortages look insignificant. What's happening right now represents the convergence of industrial revolution and monetary crisis that creates once-in-a-generation wealth transfer opportunities. The hidden silver crisis. They never wanted you to understand what's really happening in silver markets. While gold gets all the headlines and Bitcoin captures social media attention, silver has quietly become the epicenter of the most severe commodity shortage in modern history. The numbers emerging from 2024 reveal a crisis that most investors still don't comprehend, and the timeline for this crisis is accelerating beyond anyone's ability to control. Here's the reality they don't want you to see. Global silver demand reached 1.16 billion ounces in 2024, while mine production delivered only 819.7 million ounces. That's a deficit of over 340 million ounces in a single year, equivalent to the entire annual production of Mexico and Peru, combined simply vanishing from the market. But this isn't a temporary imbalance that will correct itself. This is the beginning of structural shortages that will compound annually for the foreseeable future. The Silver Institute, the industry's most authoritative source, confirms that 2024 marked the fifth consecutive year of structural market deficits. 5 years of consuming more silver than the world produces. 5 years of drawing down inventories that took decades to accumulate. 5 years of setting up the most explosive commodity price movement of our lifetimes. But here's what makes this crisis different from every other commodity shortage you've witnessed. Industrial demand alone consumed 680.5 million ounces in 2024, representing 83% of total mine production. This isn't jewelry demand that fluctuates with fashion trends. This isn't investment demand that responds to economic cycles. This is permanent, irreversible consumption that removes silver from circulation forever. The mathematics are undeniable. When industrial applications consume 83% of annual production, only 17% remains available for investment, jewelry, and monetary purposes. That 17% must satisfy global investment demand, central bank purchases, jewelry manufacturing, and strategic reserves. The numbers simply don't work, and they're getting worse every month. The solar industry explosion. The solar industry has become the single largest consumer of silver on Earth, and what's happening in this sector should terrify anyone who understands supply and demand fundamentals. Solar photovoltaic applications consumed 232 million ounces of silver in 2024, representing 28% of global mine production. To put that in perspective, that's more silver than the entire annual production of Peru, the world's second largest silver producer, going exclusively into solar panels. But the real shock isn't what happened in 2024. It's what's guaranteed to happen over the next 5 years as the global solar industry undergoes the most dramatic technological transformation in its history. Manufacturers worldwide are shifting from older PERC technology to TOPCon and heterojunction cells that require 50% to 100% more silver per panel. This isn't a gradual transition that markets can adjust to. This is a mandated technological shift that guarantees massive increases in silver consumption, regardless of price levels. China, which produces over 80% of global solar panels, has mandated this transition to high-efficiency technologies by 2028. The Chinese government isn't making this decision based on silver market dynamics or cost considerations. They're mandating it based on energy efficiency requirements and climate commitments that override economic factors. This means silver consumption for solar applications will increase dramatically, whether silver costs $50 per ounce or $150 per ounce. The scale of global solar deployment makes this consumption unstoppable. The International Energy Agency projects that global solar installations will reach 346 gigawatts annually by 2028, nearly double current levels. Each gigawatt of new solar capacity requires approximately 10 to 15 tons of silver using current technology. But remember, the industry is transitioning to technologies requiring 50 to 100% more silver content. This creates a mathematical nightmare for silver supply. If global solar installations double while technology transitions require twice the silver per installation, total solar silver consumption could reach 400 to 500 million ounces annually by 2028. That would represent nearly 50% of current global mine production going exclusively into solar panels. The European Union's Green Deal mandates massive solar deployment across member nations. The United States Inflation Reduction Act provides unprecedented subsidies for solar installations. India's national solar mission targets 280 gigawatts of solar capacity by 2030. Every major economy has committed to renewable energy transitions that require exponentially increasing silver consumption. These aren't market-driven decisions that respond to price signals. These are government mandates backed by climate commitments and energy security concerns. Solar installations will continue regardless of silver costs because energy policy overrides commodity market dynamics. The electric vehicle revolution. Electric vehicle production adds another massive layer to the silver consumption crisis. And the timeline for this demand explosion is accelerating faster than supply chains can adapt. While exact EV silver consumption data isn't published separately by manufacturers, industry analysis reveals that electric vehicles require 25 to 50 grams of silver compared to 15 to 20 grams for traditional internal combustion vehicles. The difference comes from electric motors, battery management systems, charging infrastructure, and advanced electronics that EVs require. Every EV contains silver in its electric motor windings, battery cooling systems, power electronics, and charging components. As EV technology advances toward higher performance and faster charging capabilities, silver content per vehicle continues increasing. Global EV sales reached 10.5 million units in 2024 and are projected to reach 30+ million units by 2030, according to Bloomberg NEF. That represents a tripling of production volumes in just 6 years. Even using conservative estimates of 30 grams of silver per EV, this growth trajectory adds approximately 27 million ounces of annual silver demand by 2030. But the real demand acceleration comes from charging infrastructure deployment. Each DC fast charging station requires 3 to 5 ounces of silver for power electronics and electrical components. The Biden administration's plan to install 500,000 charging stations across America alone would consume 1.5 to 2.5 million ounces of silver. China's plan for 4.8 million charging points by 2030 would require 14 to 24 million ounces. The automotive industry's transition to electric powertrains is irreversible due to government mandates worldwide. The European Union will ban internal combustion engine sales by 2035. California and several other states have similar mandates. China requires 40% of new vehicle sales to be electric by 2030. These aren't market preferences that can change based on silver prices. These are legal requirements that guarantee continued demand growth. Tesla, the world's largest EV manufacturer, produced 1.8 million vehicles in 2024. Their target of 20 million vehicles annually by 2030 would require approximately 18 to 36 million ounces of silver just for one company's production. When you multiply this across all global EV manufacturers, the silver consumption becomes staggering. The electronics and technology demand. Beyond solar and automotive applications, the broader electronics industry continues expanding silver consumption across every technological advancement of the modern economy. The deployment of 5G infrastructure requires silver for high-frequency applications where no substitute materials can match silver's electrical conductivity properties. Artificial intelligence data centers consume massive amounts of silver for server components, cooling systems, and electrical infrastructure. Each AI server requires approximately 1 to 2 ounces of silver for optimal thermal management and electrical performance. With global AI infrastructure investment reaching $200 billion annually, This represents tens of millions of ounces of additional silver demand. Medical device manufacturing increasingly relies on silver's antimicrobial properties for surgical instruments, wound dressings, and implantable devices. The global medical device market is projected to reach $718 billion by 2030, with silver-containing products representing a growing percentage of this market. Water purification systems use silver nanoparticles for sterilization in both municipal and industrial applications. As global water scarcity increases and environmental regulations tighten, silver-based purification technologies are becoming standard across multiple industries. The Internet of Things revolution requires silver for billions of sensors, smart devices, and connectivity components. Each smart device contains small amounts of silver, but when multiplied across projected deployment of 75 billion connected devices by 2030, the cumulative consumption becomes significant. Renewable energy storage systems require silver for battery management, power conversion, and electrical connections. As grid-scale energy storage deployment accelerates to support renewable energy integration, this creates another growing source of silver demand. The supply crisis mathematics. The supply side of the silver equation reveals why prices are exploding and will continue climbing regardless of economic conditions or monetary policy changes. Silver mine production in 2024 reached 819.7 million ounces, representing only a 0.9% increase from 2023 levels. This minimal increase came despite silver prices rising over 30% during the year, proving conclusively that supply cannot respond to price signals. The reason lies in geological and economic realities that most investors don't understand. More than 70% of silver comes as a byproduct of copper, lead, and zinc mining operations. These mines operate based on base metals economics, not silver prices. Mining companies make production decisions based on copper and zinc market fundamentals, with silver as an incidental byproduct. This creates a unique dynamic where silver supply is essentially fixed regardless of silver prices. Even if silver reaches $100 or $150 per ounce, silver production won't increase significantly because the primary metals driving mining decisions operate in completely different market cycles. Mexico, the world's largest silver producer, extracted 189.5 million ounces in 2024, but Mexican silver production has been declining since 2016 due to ore grade deterioration and mine depletion. Peru, the second largest producer, faces similar challenges with aging mines and declining ore quality. China produces approximately 116 million ounces annually, but Chinese domestic consumption exceeds 200 million ounces, when including both industrial and investment demand. China has become a net importer of silver, despite being a major producer, removing additional supply from global markets. The development timeline for new silver mines makes supply response impossible within relevant timeframes. New mining projects require 7 to 10 years from discovery to production, assuming favorable permitting and financing conditions. Even with unlimited capital allocation, new supply couldn't address current deficits before demand increases make the situation even more severe. Existing mines face depletion schedules that compound the supply crisis. Many of the world's largest silver mines are mature operations with declining production profiles. The famous Cannington mine in Australia, once the world's largest silver producer, has seen production decline by over 60% from peak levels. Exploration spending for silver has been inadequate for decades due to historically low prices. Mining companies allocated capital toward gold, copper, and other metals with stronger price performance. The lack of exploration investment means the pipeline of future silver projects is critically thin. The recycling reality. Recycling provides minimal relief to the supply crisis, contributing only 193.9 million ounces in 2024, according to Silver Institute data. This represents approximately 17% of total supply, far below the recycling rates achieved by other precious metals. The recycling rate for silver is only 19%, compared to 35% for gold and 38% for platinum. This low recycling rate occurs because silver's primary industrial applications don't return metal to markets for decades, if ever. Solar panels have 25 to 30-year lifespans, meaning silver installed in today's panels won't return to the market until 2050 or later. Even then, recycling silver from solar panels is technically challenging and economically marginal at current price levels. Electronic components contain small amounts of silver that are rarely recovered due to processing costs. The silver in smartphones, computers, and consumer electronics is effectively lost forever when these devices are discarded or recycled for other materials. Medical applications often involve single-use products where silver cannot be recovered. Antimicrobial coatings and wound dressings consume silver permanently without possibility of recycling. The silver going into these industrial applications is effectively removed from circulation permanently, creating a one-way flow that continuously reduces available supply. Unlike gold, which is primarily held in forms that can be recycled indefinitely, silver is consumed in applications that destroy its recyclability. The paper market manipulation. What's happening in physical silver markets is completely disconnected from paper trading on the COMEX futures exchange, creating artificial price suppression that's becoming impossible to maintain as physical shortages intensify. The COMEX silver futures market trades over 150 times more silver annually than actually exists in deliverable form. This massive paper trading volume creates artificial liquidity that allows large financial institutions to suppress prices through coordinated selling of futures contracts that have no backing in physical metal. Silver inventories at major exchanges have fallen to critically low levels throughout 2024. COMEX silver stocks declined to 270 million ounces, the lowest levels since 2016. The London Bullion Market Association reports that available silver stocks are at multi-year lows, with most remaining inventory concentrated in Asia, where it's unavailable to Western markets. This paper manipulation becomes impossible when physical demand exceeds available supply by such massive margins. When industrial users cannot source adequate silver supplies, they begin bypassing paper markets entirely and contracting directly with miners and refiners. This removes physical metal from the paper market system and exposes the artificial nature of futures pricing. The evidence of breakdown is already appearing in premium structures across global markets. Physical silver coins and bars are trading at premiums of 15 to 25% above spot prices, indicating severe shortages in retail markets. Industrial users are reporting delivery delays and allocation restrictions from major suppliers. Silver Eagles from the U.S. Mint are selling at premiums exceeding $8 per ounce over spot prices. Canadian Maple Leafs command similar premiums. These premium levels indicate that physical markets are pricing silver far above paper market quotations. The disconnect between paper and physical markets creates arbitrage opportunities that sophisticated investors are exploiting. Buying physical silver at paper market prices plus premiums while selling futures contracts generates profits as the spread widens. But this arbitrage is limited by physical availability and storage constraints. The price explosion. Mathematics. The mathematical certainty of continued price increases becomes undeniable when examining the trajectory of converging demand factors against fixed supply constraints. Solar industry demand is projected to reach 300+ million ounces annually by 2027 as technology transitions accelerate and global installations double from current levels. Electric vehicle production will add tens of millions of additional ounces as sales grow from 10.5 million units today to projected 30+ million by 2030. Electronics, medical devices, and other industrial applications continue expanding consumption across all categories simultaneously. Meanwhile, mine production faces geological constraints that prevent significant increases regardless of price levels. New silver mines take 7 to 10 years to develop from discovery to production. Even with unlimited capital allocation, production couldn't ramp fast enough to address current deficits, let alone future demand increases. The Supply-Demand Mathematics Project, annual deficits exceeding 400 million ounces by 2027, representing nearly 50% of current mine production, simply disappearing from markets every year. No commodity market can sustain deficits of this magnitude without catastrophic price adjustments that restore balance through demand destruction. Bank of America's Commodity Research Division projects silver reaching $65 per ounce by 2025, but their models appear conservative given the accelerating industrial demand dynamics and supply constraints. Independent analysts using pure supply-demand fundamentals project $100 to $130 per ounce by 2026 to 2027. Historical precedent supports these aggressive price projections. When essential commodities face supply shortages, prices can increase 5 to 10 times fundamental values before demand destruction occurs. Palladium increased from $500 to over $3,000 when automotive demand exceeded supply. Lithium rose 2,000% during the electric vehicle boom before new supply sources came online. Silver's situation may prove more extreme because industrial demand cannot substitute alternative materials at current technology levels. Solar panels require silver for electrical conductivity that no other metal can match. Electronics need silver for thermal management properties that are unique. Medical devices depend on silver's antimicrobial characteristics that cannot be replicated. The price elasticity of silver demand is extremely low for industrial applications. Solar manufacturers will continue using silver, even if prices double or triple, because the efficiency gains justify higher material costs. EV manufacturers cannot substitute alternative materials without compromising performance. Electronics companies have no viable alternatives for high-frequency applications. The monetary dimension. While industrial demand drives the primary shortage, monetary factors are accelerating the crisis as central banks worldwide increase precious metals allocations in response to currency debasement and geopolitical tensions. Though gold receives most attention in monetary policy discussions, silver benefits from the same monetary debasement dynamics while offering additional industrial growth exposure. Inflation concerns drive safe haven demand that compounds industrial shortages. When currencies lose purchasing power through monetary expansion, investors seek real assets that maintain value over time. Silver offers both monetary protection and industrial growth exposure, creating dual demand pressures that don't exist for purely monetary metals like gold. The Federal Reserve's monetary policies have created asset bubbles across financial markets, while simultaneously driving inflation in real goods and commodities. Silver represents one of the few assets that benefits from both monetary expansion and real economic growth in renewable energy and technology sectors. Sovereign wealth funds and institutional investors are beginning to recognize silver's unique position in the global economy. Unlike gold, which is primarily monetary, silver serves essential industrial functions that guarantee baseline demand, regardless of economic conditions or monetary policy changes. The potential for central bank digital currencies adds another monetary dimension to silver demand. While CBDCs are digital, they require massive technological infrastructure that consumes silver for data centers, communication networks, and electronic systems. The irony is that digital currencies may increase demand for physical silver through their technological requirements. Currency debasement accelerates as governments worldwide increase deficit spending and central banks maintain accommodative monetary policies. The US dollar, euro, yen, and pound sterling all face long-term debasement pressures that drive investors toward real assets with intrinsic value. Silver's dual nature as both monetary and industrial asset creates unique protection against multiple economic scenarios. In inflationary environments, silver benefits from monetary debasement. In deflationary scenarios, silver benefits from industrial demand that continues regardless of economic conditions. The geopolitical acceleration. Geopolitical tensions are accelerating every factor driving silver demand while simultaneously constraining supply chains and creating additional strategic demand from governments worldwide. Trade disputes have disrupted silver flows between major producing and consuming nations. Sanctions have removed significant suppliers from global markets. The conflict in Ukraine disrupted Russian silver exports to Western markets. Russia produces approximately 45 million ounces annually, representing 5.5% of global mine production. Western sanctions have redirected this supply toward China and other non-aligned nations, reducing availability for European and American markets. Trade tensions with China have complicated silver supply chains, despite China being both a major producer and consumer. Chinese domestic consumption exceeds domestic production, making China a net importer, despite significant mining operations. Trade restrictions could further constrain silver availability for Western industrial users. Meanwhile, governments worldwide are mandating renewable energy transitions that require massive silver consumption, regardless of geopolitical considerations. The European Union's Green Deal, China's carbon neutrality goals, and America's Inflation Reduction Act all drive solar installations that consume unprecedented quantities of silver. These policies create government-mandated demand that's completely price-insensitive and geopolitically driven. Solar installations will continue regardless of silver costs, because climate policies and energy security concerns override economic considerations. This guarantees continued consumption growth, even if prices reach extreme levels. National security considerations add another demand layer that most analysts underestimate. Silver is essential for military electronics, satellite systems, radar technology, and defense communications. Nations cannot reduce silver consumption for critical defense applications, regardless of price levels or supply constraints. The Pentagon's Strategic Materials Assessment identifies silver as critical for national security due to its role in advanced weapon systems and electronic warfare capabilities. Military applications require the highest purity silver and cannot accept substitutes that might compromise performance. Space technology and satellite deployment consume increasing quantities of silver for solar panels, electronic systems, and communication equipment. The global space economy is projected to reach $1 trillion by 2040, with silver consumption growing proportionally. The investment implications. The investment implications of this silver crisis extend far beyond precious metals markets into a fundamental restructuring of global wealth that will create massive winners and losers based on positioning before the transition becomes obvious to mainstream investors. Physical silver offers the most direct exposure to this transformation, but supply constraints make large accumulations increasingly difficult as premiums continue expanding. Retail silver availability has become sporadic, with major dealers reporting allocation restrictions and extended delivery times. Silver mining companies provide leveraged exposure to price increases, though most silver miners are actually base metals companies where silver represents a byproduct rather than primary focus. Pure silver miners like First Majestic Silver, Hecla Mining, and Pan American Silver offer more direct exposure, but face the same geological constraints that limit production increases. The few companies with significant silver exposure trade at valuations that don't reflect the coming supply crisis. First, Majestic Silver trades at enterprise value ratios that assume silver prices remain at current levels indefinitely. Hecla Mining's valuation implies no recognition of the industrial demand explosion occurring across multiple sectors. Silver ETFs like SLV and PSLV provide market exposure without storage concerns, but their ability to source physical metal during extreme shortages remains questionable. The fine print in these funds reveals they may settle in cash rather than metal during supply crises, defeating the purpose of precious metals exposure. The Sprott Physical Silver Trust, PSLV, offers better protection because it holds allocated silver in secure storage, but even this fund faces sourcing challenges as physical availability declines. Premium structures for PSLV shares indicate growing recognition of physical silver scarcity. Silver streaming companies like Wheaton Precious Metals and First Majestic provide exposure to silver production without operational risks of mining. These companies purchase silver at fixed prices from mining operations, providing leveraged exposure to price increases while avoiding mining costs and risks. The options market for silver offers additional leverage opportunities, but liquidity remains limited compared to gold or equity markets. Call options on silver miners provide asymmetric risk-reward profiles for investors willing to accept higher volatility. The timeline for action. Multiple catalysts are converging in 2025 to 2026 that will make silver shortages impossible to ignore, even for mainstream financial media and institutional investors who have dismissed precious metals for decades. Solar industry demand will reach record levels as government mandates accelerate installations globally. The European Union's renewable energy targets require massive solar deployment by 2030. China's carbon neutrality commitments drive continued manufacturing expansion. America's Inflation Reduction Act subsidies are accelerating domestic solar installations. Electric vehicle production will hit inflection points that strain silver supplies further as major automakers transition entire product lines to electric powertrains. Tesla's production targets, GM's electric vehicle commitments, and European automaker transitions all require exponentially increasing silver consumption. Most importantly, the paper manipulation mechanisms that have suppressed silver prices are breaking down as physical demand overwhelms available supplies. When paper markets lose credibility due to inability to deliver physical metal, price discovery shifts to physical markets where shortages are already critical. The mathematical certainty of this outcome makes silver one of the few asymmetric investment opportunities where downside is limited by industrial demand floors, while upside potential is extraordinary due to supply constraints. Current prices still reflect paper market dynamics rather than physical market realities. But timing matters because once this supply shock becomes obvious to institutional investors, the opportunity to accumulate silver at current prices will disappear forever. The smart money is already positioning through direct purchases, mining company investments, and strategic allocations. Conclusion. The silver reckoning isn't speculation or conspiracy theory. It's mathematical certainty based on verified data from the Silver Institute, International Energy Agency, and industry sources worldwide. 5 consecutive years of supply deficits. Industrial demand consuming 83% of mine production. Solar industry alone requiring 28% of global output. Technology transitions demanding 50 to 100% more silver per application. Mine production increasing only 0.9% despite 30+% price increases, proving conclusively that supply cannot respond to demand growth. Recycling providing minimal relief at 19% rates compared to 35% for gold. Paper markets trading 150 times available physical supply, creating artificial price suppression that's becoming unsustainable as physical shortages intensify. Silver hit $71.94 in December 2025, up 141% year to date. And this is just the beginning of a price explosion that will reshape commodity markets. Bank of America projects $65. Industry analysts forecast $100 to $130. Historical precedent suggests even higher targets when essential commodities face supply shortages. But specific price targets matter less than understanding the fundamental transformation occurring in global silver markets. This isn't speculation based on monetary policy or inflation fears. This is mathematical certainty based on industrial consumption that cannot be stopped, reduced, or substituted, combined with supply constraints that cannot be overcome through price increases alone. The convergence of solar industry expansion, electric vehicle adoption, technological advancement, and constrained supply is creating conditions for one of the most significant commodity price movements in modern financial history. The numbers don't lie, the mathematics are verified, the timeline is accelerating. We're watching the setup for what could be the most explosive precious metals move of our lifetimes. While everyone chases the latest crypto trends and debates interest rate policy, the real story is unfolding in plain sight. An industrial revolution that's systematically removing silver from global markets faster than it can be replaced. The silver reckoning has begun. The mathematics are unavoidable. The timeline is accelerating. And the wealth transfer of our lifetimes is happening right now, whether you participate or not.